6.5 minutes and counting. All right. Good morning, Checkmate crew. It is 30 minutes after the opening bell of the New York Stock Exchange at 10 a.m. Eastern Time. Today is Wednesday, January 4th, 2023. Yours truly, Mickey Blindside here with your market memo. Okay, so first things first, as always, let's take a look at the opening market today. So today the VIX is, it looks like it's a little bit flat today at 2290. And S&P 500, it was up a little bit more today. It just dropped this minute. Now it's just going back and forth between a quarter point increase or a 0.5% increase for the day. We've been seeing outsized moves up in the VIX compared to drops in the S&P 500. In the last few sessions, let's say last 3 sessions, 4 sessions, we're up on the VIX. On the S&P 500 for the last, let's say 4 days or so, we're flat, let's say we're flat. But the VIX futures is actually down the last 4 days. So it's a very interesting mix that we're in. I do think that, just like our thesis at the end of the year, back in 2022, we said that, we talked about it more in the end of 2022, but we actually were talking about it in the summertime. We might see we're starting to see the setup for that mini rolling bull market for 2023. I said that if we start seeing outsized VIX upward spikes for very small downward moves in the S&P 500, that is a signal that there is hedging demand that's coming back into the market. And so that is going to be fuel for the rally as we go forward. Now, most institutions, when they hedge, of course, there's been increased daily hedging with all the, 0 DTE, the, daily S&P 500 expirations. But a lot of institutions also hedge 6 months to a year out. And so when they buy all those puts, it can also cause rallies to come about later on. And, we've talked about this at great length. We've talked about how the market maker mechanics works behind the S&P 500. In most institutions are long shares, or they're long the S&P 500, or they're long a basket of stocks. And in order to hedge, they will use S&P 500 puts. Okay, and so when they buy puts, it bids up the premium on contracts, and that's why the VIX goes up. The VIX is just an index of the options premium that's on the S&P 500. So as institutions buy puts, market maker has to sell puts. Selling puts is a bullish position. So in order to go delta neutral to make sure that small movements in the market don't affect their portfolio, they actually have to go short on the underlying, which is the S&P 500, in order to remain delta neutral. Okay, and so so all that put buying creates a larger short position for the market maker, and so when those puts decay, or if those puts get cashed, the market maker will have to buy the underlying to remain delta neutral. Okay, and so that is why when we see lots of put buying and lots of over hedging in the market, that can lead to these big rallies in the market, because as people try to unwind that position, the market maker has to balance that out, balance all that trading activity out, and they also have to get long in order to facilitate that unwind, okay? And so we've talked about this at length. We're starting to see that. We're starting to see the setup for that. It still doesn't mean that for sure it's going to happen, but it does mean that the setup is there, and we've been talking about this for months. So, this is no surprise to us that we're seeing the VIX stay elevated. I do think the VIX is going to stay elevated, and again, this supports our case that we might see this rolling mini bull market that may last for a couple of months, and I wouldn't be surprised if it starts sometime after January 20th to the 24th, which is after the 30-day period after all those tax sales or tax sale harvesting that we saw in December. Okay, so all of that is kind of linked together. All right. So that's what I see so far in S&P 500 VIX. All of the things that we've talked about, they're starting to come into motion. Okay, the setups are there. All right. I mean, now that we're talking about risk on, risk off, we might as well stay on that topic here. The dollar is pulling back a bit. Well, it pulled back further, and it's coming back up. It's trying to regain that 18-day moving average. This dotted blue line right here is where I place my 18-day moving average. This is my chart that has all the lines on it. It has my Bollinger Bands and everything, but sometimes I like to just get rid of that previous noise and just look at the current, where my current lines are. And so, the red dashed lines are where the weekly 2 standard deviation Bollinger Bands are. So right now, the market is just chopping around its 18-day moving average. Could it get above it? I mean, we'll see. I still have my UUP calls, just so you guys know, I still have them. We're a little underwater on this. Again, I'm using this mostly as a hedge. Oh, it went up a little bit today, but it's my hedge on the quad U shares that I have, because if the dollar spikes, those quad U and any type of metal miner or any type of materials miner is going to go down because of that. So right now, I do have these as my hedges. I still have them. I'm still looking for the dollar to go up. Speaking of currencies, we always talked about, the euro, the British pound, and the Japanese yen as being forward indicators for the market. And right now, EURUSD is up a bit. The EURUSD is up a bit. It's causing the European markets to go up, and we'll cover that a little bit later on today. The British pound is also up, all right, and the Japanese yen is also, the Japanese yen is down today. So actually, there was another announcement today that in Japan, they're doing yet another round of bond buying, which is part of their yield curve, yield curve control program that they have. They're buying more and more of their longer dated maturity bonds, and they're still quite dovish. And so this is probably going to continue. Now, most institutional funds are selling their Japanese bonds into this. So we'll see. I mean, I think I don't think there is a trade on this. It's so unpredictable, the messaging that's coming out of the Bank of Japan. I really don't think it's tradable at all. I mean, we did have a plan on shorting this or going long. So shorting the USDJPY is like going long the Japanese yen. This is an inverted chart. So, we were talking about going long the Japanese yen here, but then we got scared out because of this price action. Those of you who took the trade, I don't know if any of you did, but if you did, congratulations. But right now, it may not be a bad idea to take some profits if you did go long the Japanese yen. Who knows what's going to happen? Kurata, the current governor of the Bank of Japan, he's supposed to step down sometime in March, April. The front runner to replace him is somebody who's got very different ideas on monetary policy than this guy. So we might see a huge policy shift, a 180-degree shift, something, again, we've been talking about here at Checkmate Trading since, June, July. We talked about a potential pivot in the Japanese Bank of Japan monetary policy. And if that happens, I think there might be a lot of volatility that happens, because first of all, if yields go up and there's a lot of tightening happening in Japan, all of a sudden the Japanese domestic investor now has a way to get positive yield domestically and doesn't have to go out as much to get that positive yield. Well, if that's the case, what happens to all that Japanese money that's out there? You may not think that it's a lot, but it actually is. Japan has one of the highest saving rates in all the world. It's basically like a very large savings account, and they do invest heavily overseas. And so if that overseas money comes back domestically to Japan, that might cause a little bit of volatility in other markets. So we shall see. again, that might be a 180-degree policy shift. And they're not like the Federal Reserve where they announce these policy shifts way in advance. The Bank of Japan tends to throw these curveballs. So I don't think there's a trade, at least for me, there isn't. For those of you who like to trade a little bit more exotic, put a little bit more risk in your trades, this may be worth your while, but to me, there's no trade on this. But I did want to mention that to you guys. As long as the Japanese yen keeps rising and this chart keeps falling, I think that puts a good amount of tailwinds for gold and silver and for the precious metals. Okay, we talked about this where if we see the Japanese yen go up, the dollar come down, we might see gold and precious metals go up. Well, lo and behold, look at this. All right, so we're seeing gold go up, we're seeing silver go up as well too. Silver was up, it's coming back down. Well, good for us because, for me at least, I'm not in any type of precious metals trade. I'm trying to get in on precious metals myself, and that's going to happen when, SILJ, which is the junior miners and so on, when it comes back down. I mean, I'm guessing that if silver can come back down to these levels right here around the $20, $21 mark, all right, and if gold can get to, I believe it was like 1730 was my level. Yeah, around 1730, 1740, if it can get there, I think that would be a very, very compelling long position on SILJ. And so you guys know that one of my main focuses for 2023 for my speculative account is going to be metals mining, primarily uranium, but also getting in on precious metals, especially on silver, okay? So I am looking for an entry into that. Speaking of currency, I mean, we just talked about some currencies before. Let's talk about the Australian dollar. The Australian dollar is on a rampage today. So there was some news that came out of China. So China came out with some news that they are considering easing the ban on Australian coal imports. Okay, so China right now, they're trying to look for ways to drop their energy costs. And right now, one of the cheapest forms of energy right now, love it or hate it, is coal. Okay, there's a lot of power plants that can run on coal in China and in the United States, well, all over the world. And it was one of the earlier mass energy forms that the world's used. And so there's a lot of infrastructure in place to be using coal. And so with the increase in price in oil and natural gas, right now coal looks more and more attractive to certain countries for their energy source as they diversify their energy sources. Another piece of news that came out was that China is they reiterated their plans to expand their fiscal spending, as well as they want to support their property developers. All of this news, I think, combined sent the Australian dollar higher. It also sent Newcastle coal futures higher. Australian dollar went up. The Hang Seng index, just rallied hard. Look at this. The Hang Seng just literally rallied 3.25% off of this. Okay, it just literally just kept going up and up and up and did not even pull back the whole day. All right, this is a monster move, guys. I'm not sure if you know this, but this is a huge, huge move. From the bottom to the top is what? It's like 42%. So when is this? Since October 31st till now. All right, October 31st till now, what is that? October to November to December. So in like two and a half months, less than 2.5 months, the Hang Seng has gone up 42%. Okay, that is ridiculous. Of course, we wanted to get into ZTO, and ZTO is also breaking out as well too. The charts kind of look similar, even though ZTO is not a tech company. Hang Seng index tends to be very tech heavy, but it's still following that kind of that same pattern. It's not coming back. It's not pulling back to our zone here. I would love to see it pull back, but we're just not seeing it. Okay, we're just not seeing it. So that's the at least the news coming out of China. Now, China also is affecting one of our other thesis that we're in, which is in shipping and maritime. So yesterday we had one of the single biggest daily drops in the Baltic Dry Index. Container freight rates, it dropped about 17.5% in one day, and that was just for the start of the year. Now, it is very normal around this time of year, especially the end of year, the last week of December, to see weaker demand in shipping, okay, because it's just a holiday month. Not many, not many large shippers are operating, and not many manufacturers are eager to get stuff up, because of end of year holiday shopping. Most companies have already gotten their merchandise out, starting in May all the way to October. Okay, and so, but Baltic Dry Index dropped about 17%. It caused all the tankers to come down. We're talking. A lot of the tankers. I mean, even our FLNG went down. So right now, I am a little bit of a drawdown in the FLNG options. Even the ones that we're looking at, like Star Bulk Shipping, all those went down. You name it, TRMD, TK Tankers, STNG, all the names, everything just went down about 4 to 5% across the board. And so one of the things that I wanted to highlight was our thesis. We know what we own, okay? We've got 2 years on those calls, so I'm not really all that worried. And actually, I'm looking to add more to our position. But one of the things I wanted to show you was that, yes, tanker rates are falling, and we saw this coming, and that's why we waited patiently to get into tankers, although I could have been a little bit more patient. Instead of getting in on Matson that early, I could have just waited a little bit more. But anyway, that's besides the point. The reason why we were patient from that October, November was because that was the peak in those shipping rates. And we said, once we see a little bit of a pullback, especially as we get into the slower season at the end of December, that might be a good opportunity for us to get in. And so, yes, lo and behold, 1 day changes. And when we're looking at some of these tanker spot rates, some of these rates went down like 14, 15%. If you look at dry bulk, like look at the Cape size, that one went down to about, 27%, in 1 week changes, we're looking at about 20 to 30% drops across the board in a lot of these, in a lot of these tanker rates, again, which is something that we've anticipated. And that's why we tried to wait for around this period to get in. Obviously, in hindsight, we could have waited a little bit more. But again, we're never going to, in trading, psychologically speaking, we're never going to get the exact bottom. We're never going to get the exact top. It's all about managing that risk. And so that's why, part of our thesis was that this was going to have a smaller position sizing, in our position management for 2023. And again, I'm going to have some links on here. If you click on the exclamation point on the top right, I'll have some links to where I discussed this thesis in depth. I'll have a few links on there, okay? So you can click on those links and go back to those videos where we discuss this in more detail. But one of the things that I wanted to point out was the LNG spot carrier rates, okay? We're still, all right, we are still at around $200,000 per day on the LNG, liquid natural gas carrier spot rate, which is quite high. I mean, if you look at some of the other tanker rates, they're not as high. Of course, it was higher before, but still the margins are very good for natural gas carriers. And I think as we get closer and closer to May, June, when we start seeing wider contango on the natural gas spot market, we may see the demand for storage increase. As the contango increases, there's more and more of an incentive for traders to hold natural gas in carriers, pay the carrier cost, and then deliver that natural gas in the future to collect a little bit more premium. Okay, and so we may see that happening, and again, I think that's going to happen more as we get closer and closer to that April-May contract. But until then, we may see a little bit of a bumpy ride. If I could do things all over again, what I should have done is I should have sold those covered calls and collared off that FLNG leap that I have. But I was a little bit greedy, and I thought it was going to go up to about 38.5 or so. And so I changed my plan. I said, I'm not going to sell covered calls until 38.5. Well, lo and behold, it didn't touch 38.5 and only touched 36 and then came back. So there you go. Word to the wise, when you see green, you take green, and I think that's a very important lesson. And, I just got spooked out by some of the covered call selling we did in the summertime. And then that hasn't really, shaken off on me, but that's a more of a psychological market psychology issue. And so, I let that get the better of me. So next time, if we get to around a green zone where our FLNG leaps are in the green, I'm definitely going to sell some out the money covered calls, and I'm going to protect my downside with some collars. And I think that's going to happen soon here. I think this is just a one-day reaction because of all the slower tanker and carrier activity for last week. I think this rebounds into next week, but we shall see. I do think that, as China reopens, these rates are going to go up. So it's all kind of connected here. Right now, I have about 0.5% of my spec account in those FLNG calls. I'm willing to double up and get to about 1%. Max, I'm willing to get up to like 2.5 to 3% of my speculative account in dry bulk shipping or in tanker or LNG carriers. And so my next acquisition is going to be SBLK. So right now I have about 0.5% in FLNG. I'm willing to put another 0.5% into SBLK, possibly even later today, based on what happens. If the daily close, if it closes around here, I'm willing to go long on another 0.5% on SBLK, and most likely what I'm going to be using is leaps. I'm looking at the January 2025s. I'm looking at either the 18s or the 15s, depending on the pricing I can get. Right now, yesterday actually, the 18s were cheaper when you price it with implied volatility. Of course, nominal price, the actual premium, is going to be more for the 15 calls because they're further in the money. I mean, that's obvious, to an options trader. But, what I mean by pricing, I'm usually, what I'm talking about is the implied volatility. Some pros actually, when they talk about options quotes, they don't even quote that price in dollars, that the premium that you pay or get sold. Usually what they're talking about, they sometimes quote the implied volatility. So I'm looking for the strike that gives me the lowest implied volatility, and right now it's the 15. Yesterday it was the 18, but today is the 15. So depending on where the implied volatilities are and where I can get a good bid in, I may be going with the 15 or the 18 deep in the money calls for January 2025. And again, I'm going to be looking at the SBLK for today's close. And again, if we close towards the low of the day, then I may not. I may hold off until we get into more of the 17s, the mid 17s. But if we close, I would say midpoint or higher, or if we close above the opening price, I will be entering in that trade at the end of the day today. Okay, so that's my plan on the tankers. Okay. What else? Later today, we have FOMC minutes coming out. It's just the minutes, all right? It's not the real FOMC meeting. That one doesn't happen until February 1st. It's just the minutes for the last meeting. So it's backwards looking. So there really shouldn't be any like huge changes to your investment thesis based on this. Although, of course, we could see, some algorithm generated volatility or buying, or maybe we might see some puts getting cashed out, because when we look at today's expiration, from today to Friday's expiration, we do have a lot of puts, and so if they get sold off, we could see the markets drift off afterwards, because we are hedged for that. For some reason, I think perhaps some traders are afraid that there might be some type of hawkish interpretation of the minutes. Who knows? If we see those puts get sold off, if we see the VIX 9-day VIX sell off, definitely that means that people are cashing in those puts. Usually for most brokers, you can find VIX 9D as the 9-day VIX. All right, and that just, it basically is the VIX calculation. The VIX measures the options premium for the next 30 days. VIX 9-day only measures it for the next 9 days. Okay, so it gives you kind of the shorter term outlook on options premium. Okay. So that's today. That happens at 2 p.m. Eastern time. We also have the jobs report coming out on Friday. It could be that a lot of traders are hedging for that to see, right now it looks like good news is bad news is good news. The Fed has repeatedly said that they're looking for a softening in the labor market before they ease up on tightening. We shall see what happens on Friday. I think the expectation, if we get, job creation that's much higher than expected, we could see a little bit of volatility. We could see hedging demand come back, and we could see a spike in the VIX. And again, if we see outsized spikes in the VIX relative to the drops in S&P 500, I think that sets us up for that mini bull market rally. And again, I wouldn't be surprised if that institutional bid comes in around January 20th to the 24th, which is 30 days after all the tax selling that happened in December. Okay, so it all kind of fits in. Next, Treasury rates. Let's take a look at some of the Treasury rates. One of the things I wanted to look at was the 10-year, the 2-year. So right now, we're looking at the 10-year. The 10-year is starting to come back down a bit, which means bond prices are going up. So for those of you trading on, TLT and stuff, you've probably noticed TLT going up in the last 2 sessions. As the 10-year comes down, all right, one thing that I wanted to show, something that we've shown a lot of times here is the copper to gold ratio, and we've said that the copper gold ratio, let me actually put this to, okay, let me show you side by side. We're going to pin this to the A scale. Yep. So as you can see, all right, it's been, usually the copper to gold ratio and the 10-year treasury will coincide with one another. Now, usually when there are divergences, the 10-year treasury tends to come back to meet the copper gold ratio, okay? And when the copper gold ratio broke out back in 2020 and 2021, it took a few months, but the 10-year treasury came back to meet it. Now, the copper gold ratio has been dropping since June of 2022, but the 10-year has been going up. Now, I do think that these are going to come back down again. They're going to coincide again. It's just which one's going to go up to meet the other. Is the copper gold ratio going to go up to meet the 10-year, or is the 10-year going to drop to meet the gold copper ratio, or the copper gold ratio? So before that institutional demand comes in, we see the copper. We see the TNX 10-year treasury yield come down. Wouldn't that be something? That would probably put a lot of tailwinds for tech stocks, which means we might see this chart flip okay, which is, this is the IVWIVE. This is the growth. This is the growth to value stock ratio. So IVW is the growth ETF. IVE is the value ETF. When this is going down, it means value is set to outperform growth. When it goes up, growth is set to outperform value. So we might see this chart reverse, okay? And so a lot of the stocks that were sold for tax loss harvesting back in December was tech stocks. So we might see institutional demand come back into tech stocks. This chart might reverse, and we might see TNX fall, which again, that would be more supportive of tech stocks getting a bid. So I'm not saying that's going to happen. I'm just anticipating what could be a possibility. The setup is there right now. The setup is there. The data's pointing towards that. We'll see if it actually plays out like that, okay? We still got about 3 weeks for that to happen. So anything can happen from now until 3 weeks. So now until then, we might see heightened volatility before that happens. So again, there's no trade on it now. We still have to remain patient. That's still about 2 or 3 weeks away. I would think that we're going to see bigger moves as we get closer and closer to that January options expiration. Could it front run, before that options expiration? Because I believe the January options expiration happens right on the 20th. So surprise, surprise, the 30-day, the estimated 30-day mark from when tax selling happened in December falls on January options expiration. That's a crazy coincidence. And so we'll see what happens. We might see that traditional, that V move by the dip that happens in and around options expiration. That may, I don't think, it's going to have to increase for like a couple more weeks at this rate in order for options data to be useful and pricing and helping us determine, the possible prices on Bitcoin and Ethereum. I think that's still a ways away. It's still chopping around certain levels. We're not really seeing any type of big moves. I mean, 3% moves here and there. I mean, so be it. I mean, right now it's starting to go above that 1241.46 level. We shall see if it closes above there. Even if it does close above there, within the next week or two, we've seen it fall. So let's see what happens in the next couple of days. If we do see an uptrend in the weekly chart, if this is to be the low, I would like to see a higher high and a higher low before entertaining any type of long trade. And again, the patient trader is going to wait for this Ethereum gold ratio. And I think we're not that far away. All it takes is, I think, one more major pullback and it's going to be there. So if we get it within the next 3 weeks, that would be a pretty compelling buy. And so again, my main buying is going to happen when that ETH gold ratio gets to that point right there. Okay. Anything else you guys want to look at? Somebody is asking, how do you do volume profiles on Think right now? You go to, it's one of your studies. I don't really use it that often, but I do know it's one of your options here because I did look it up once for somebody. Volume, here it says volume profile. Volume profile. So if you click that, you can actually view this. This is the volume profile. Show the study. Let's take a look. Boom, there you go. Volume profile. So on Thinkorswim, all you got to do is go to studies, look up volume profile, and then you can put your inputs, and you can go from there. I use it sparingly. All right, I use this very sparingly, only for like short-term trading. I don't use it for long-term. I might set like certain, I might be able to set some stops or something on those levels, but it doesn't really affect my decision making all that much. I don't really use it all that often. If you guys know of a better way of using it, let me know. I'm always interested in seeing how people use it. All right. Anything else you guys want to look at? All right. Well, going once, going twice. All right, then in that case, that wraps up our session of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord, be a part of our growing community. No sub fees, no paywalls, of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'll be back on tomorrow, Thursday, 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern time. Trade safe, guys. I will see you